Hello and welcome to Business Africa with me, Ronald Kato. This week, it is nearly a year since Europe and Africa vowed to build a new partnership, more trade and investment. But there's not much for the two continents to show in terms of concrete action. We assess the dynamics driving the complex nature of Europe-Africa ties. Plus, faced with a biting dollar shortage and rising debt, Ethiopia is considering devaluing its currency, the birr. The move is supported by the IMF, but Addis Ababa is concerned about making inflation, already hovering above 30%, worse. Also, not very good news for the global economy in 2023 as economists predict a recession. Interest rates are also projected to stay high as policymakers battle inflation. Stay with us for the details. Thank you for joining us. Now, almost a year since the summit in Brussels, European leaders and their African counterparts are struggling to get moving. There's been no major decision from Brussels on investment or infrastructure, two things African leaders deeply care about. That no new money has come from Europe to Africa has hurt expectations, along with hope that a new partnership can be built.
It's been nearly a year since European leaders and their African counterparts converged in Brussels for a summit billed as the beginning of a renewed partnership between the two continents. The summit's final declaration, dubbed the Joint Vision for 2030, promised, among other things, to invest in Africa $25 billion per year over the next 7 years, 450 million COVID vaccines, and over $300 billion to spend on energy and infrastructure. While both the European Union and African Union have not provided a progress report, observers say there has been more hype than action. The war in Ukraine has had Europe distracted and even caused tension with African countries who have chosen neutrality. The summit also appears to have done little to improve mutual trust. With Europe still not keen on supporting a patent waiver on vaccines, doubts have grown on whether Brussels is serious about the continent's health sovereignty. Energy, too, remains a key driver of friction. While Africa is keen to develop its oil and gas reserves, Europe is not keen to invest, insisting only on renewables. In a continent where more than 600 million people live in the dark, Europe's attitude continues to disappoint many.
Gert Laporte is an expert on Europe-Africa relations at ECDPM. Thank you so much, sir, for your time. How are things going between Europe and Africa? Has the energy from last February kept up?
Well, I must say that when the heads of states were meeting last year around this time, mid-February in Brussels, there was quite some enthusiasm. But then, of course, just 1 week after the summit, the war in Ukraine started. And I think this really created a different type of setting, a different type of relationship. What the war in Ukraine did, and also COVID-19 did this to some extent, was to spell out, to expose some of the underlying tensions, some of the underlying frustrations in the partnership between Europe and Africa. Europe, for example, was very disappointed that quite a number of African countries did not fully support them in condemning Russia. But at the same time, on the African side, there was also a lot of frustration. They saw how African migrants in Ukraine were treated when they wanted to leave Ukraine. They also saw how Ukrainian refugees were very much welcomed in Europe, in the European Union member states, which has not been the case with African refugees.
Let's talk about the global gateway, big on ambition, tiny on action. Is this the consequence of designing policy interventions with only geopolitical considerations in mind?
What the Europeans have been doing with the global gateway is to present a kind of European alternative to the Belt and Road Initiative of the Chinese. And of course, by putting big amounts of money on the table, they wanted to impress its various partners, particularly Africa. There's nothing wrong with this, I think, but what frustrated some of the African side in this discussion was that they were not fully consulted when this global gateway was presented to them. It was presented as if this was a major present from the European side to Africa. And then a second area, after having studied the various proposals, was, okay, where is this money coming from? Are we recycling resources that were already promised to Africa a few years ago? So I think the biggest fear at this moment is that this global gateway might not keep up the huge promises that were made when it was presented.
Energy is obviously another driver of friction between both continents. While Europe, burns coal and doubles down on gas imports, it is advocating renewables for Africa. Do you see both sides reaching a compromise on this?
On the African side, there is a fully legitimate questioning of what the Europeans have been trying to impose on Africa. Clean energy in Africa, that's fantastic. Everyone agrees with this, of course, in principle. But the pathway to get to that clean energy will take time. And in the meantime, Africa, of course, has the right to industrialize. It has the right to create value added, to create jobs, and it should have the right to use its fossil fuels. But we should have a balanced way of looking at all this. There should be pathways to design in the next years to come towards clean energy, which is a joint objective that we all share.
Gert, the Europe-Africa relationship certainly isn't a perfect one, but is a necessary one. How do we proceed from here?
I think we should have an open dialogue on all these issues where there is tension. And we should assume joint responsibilities, because many of these issues cannot be solved by one party. It has to be negotiated, and there the Europeans will have to learn to negotiate with a more assertive African partner. They were not used to do that in the past. There's a whole range of issues where we have, at this moment, conflict, and we should discuss them very openly. And this means also that on the African side, maybe, I think, there should also be a wish to renounce to some of the easy money that is being offered by the European side, because the European side always tries to solve these issues with funding, with money, and money is not a solution always. Sometimes it is needed, but it creates also dependency.
Gert Laporte, nice to have you. Thank you very much for your time.
With pleasure.
A dollar shortage in Ethiopia has put so much strain on the local currency, the birr, with a major gulf in the official and black market exchange rates. As a remedy, the country's central bank is considering devaluing the currency. The move is necessary for Addis Ababa to attract IMF support and to boost exports.
Ethiopia's account deficit has been growing since 2020 as multiple factors, including the COVID-19 pandemic, the war in Ukraine, and the conflict in Tigray, converged to weaken the economy. A shortage of dollars caused by reduced exports and remittances have sent exchange rates spiraling, placing significant pressure on the birr. Despite Addis Ababa banning the importation of certain goods to save forex, the country's reserves have continued to falter. Falling reserves are also making it hard for Ethiopia to repay its dollar-dominated debt, sending already panicked investors and creditors into more worry. To correct its trade deficit, the government faces the tough option of devaluing the birr, a move that would harmonize the official and black market exchange rates. Devaluation has also been backed by the IMF, the multilateral lender Addis Ababa has approached for financial assistance. While devaluation could help solve one set of problems, Addis Ababa is also worried about the risk of turbocharging inflation, which is already above 30%.
Now, a majority of private and public sector chief economists surveyed by the World Economic Forum expect a global recession in 2023. it is not good news for economies already struggling to recover from pandemic stress.
The organization's survey was based on 22 responses from a group of senior economists drawn from international agencies, including the International Monetary Fund, investment banks, multinationals, and reassurance groups. 18% of the economists surveyed considered a world recession extremely likely, more than twice as many as in the previous survey conducted in September 2022. Only one-third of respondents to the survey viewed it as unlikely in 2023. The World Bank last week slashed its 2023 growth forecast to levels close to recession for many countries as the impact of central bank rate hikes intensifies and the war in Ukraine. The majority of the economists see further monetary policy tightening in Europe and the United States, with policymakers caught between controlling inflation and leaving room for growth.
And that wraps up this episode of Business Africa with me, Ronald Kato. The news continues on air and online. Bye for now, and I'll see you on the next episode of Business Africa.